Hi, it's Dre Griggs with Obsidian Wisdom. Today we'll answer the question, what is the best dividend investing strategy? Today we'll go over the 7 best dividend income investing strategies that you can use to create your retirement income. It's worth noting that 65% of millionaires have at least 3 streams of income. Depending on your other streams of income, dividend income, which is also known as investment income, is one of the better streams that people enjoy having. The first one is dividend growth investing. There are 2 things that you're looking for when it comes to a dividend growth income. The first one is you're actually looking for the stock to be appreciating. And what that does is it opens an additional stream of income for you, which we call capital gains, if you hold the stock for at least a year and a day. For most people who are dividend investing, you already know this is a long-term strategy. This is not something that's going to happen overnight. And so for most people, this actually is a pretty good strategy because it aligns 2 streams of income. One is your investment income that you're achieving through dividends. The other is your capital gains income that you're achieving through the appreciation of the stocks that you have. The second thing you're looking for in a dividend growth investment is you're looking for your dividend to be increasing over a long period of time. Now, that number can vary, but I often say at least 5 years. If you can show me a dividend that's been increasing over 5 years with a stock that we expect to be appreciating, that normally will fall within the dividend growth investing strategy. The second dividend investing strategy is what we would refer to as high yield dividend investing. Now, you'll rarely hear me tell you that you should just purely be chasing the yield. And there's other videos where I discuss some of the issues with that. There are some companies that know you're looking for a high dividend, so they're going to offer you a significantly high dividend, knowing that it is unsustainable. And so, what I mean by unsustainable is let's say that the earnings per share is maybe $5 and the dividend is $4. Well, that means that they're giving out 80% of their earnings per share in the form of a dividend. Now, while that may be a high yield and very attractive, you can also see why that's probably not sustainable. There's really 2 reasons for it. One is most companies, if you're giving away 80, 100, 150% of your earnings, well, then what are you going to be able to reinvest in the company to grow the company? And that's often the issue that you find when someone is solely focused on chasing high dividend yields. But if you have it a part of a diversified portfolio where you do have some high dividend yields, but you also make sure that the payout ratio is not too much of the earnings. Normally, it's good to be around like 50, maybe even 75%. But once you get close to 100% of the earnings being given out in the dividend, most of the time, that's something that I would run away from. It just doesn't really make sense long term. And again, as I've mentioned to you, dividend investing is a long term game. You're often going to be reinvesting your dividends in the early going. That's often referred to as a drip strategy, which is your dividend reinvestment plan. For many people, because it is a long term strategy, you have to have a long term viewpoint and perspective. If you allow yourself to get trapped in some of these dividends that are just going to suck away your money, but nothing's really going to happen in the next 5 years, then you really are missing out on some golden opportunities, which is why it'd be very beneficial for you to find companies not only with a high dividend yield, but they also have high earnings to support those dividend yields. Where again, as I mentioned, you want to be in that 50 to 75%. We know that that's something that's more sustainable as far as a percentage of the earnings per share. Number 3 on our list of dividend investing strategies is dividend aristocrats and kings. And you may be asking, well, what is an aristocrat and king? Well, back in the day, they were very fancy, noble people with the aristocrats with the pinky out when they were drinking their tea. They wore the big fluffy clothes and they was probably very hot and very itchy and it was probably pretty annoying, but they wore it because they wanted everybody to know that they were the bee's knees. When it comes to a dividend aristocrat, you are looking for companies that have been consistently paying a dividend for 25 years and they've been consistently increasing their dividend for those 25 years as well. When it comes to a dividend king, you'll be looking for companies that have been paying and increasing their dividend consistently for 50 years. These are nice balances to have in your portfolio. They're normally very stable companies to be paying a dividend for 25, 50 years. Obviously, the company itself has been around at least that long, which is a very nice, stable, and conservative stock to add to your overall portfolio. Now, you may not be able to have all dividend aristocrats and kings because if you've been paying a dividend for 25, 50 years, they're probably not going up that much after a while, right? There's only so much opportunity that you have. Now, from a percentage standpoint, it may be going up a nice percentage, but it is nice to have a percentage of your portfolio that's allocated towards having companies that consistently pay dividends and consistently increase their dividend, regardless of how much that yield may be, just as a nice, safe, conservative hedge to add to your overall portfolio. Number 4 on our list is dividend ETFs and mutual funds. So for some people, they just don't like the idea of choosing individual companies where we're going through some of these reports, looking at the numbers, looking at the fundamentals. We're looking at the dividend. We're seeing what the percentage yield is. We're looking at the projected earnings to see what the ratio is. And some people just feel like that's a lot of work. And if you're someone that feels that way, then you may be able to say, you know what? let me just go ahead and invest in some ETFs. I'll pick a couple dividend mutual funds and then I'll build my portfolio and I'll be fine with this because I'm probably going to have anywhere between 25 to 100 different stocks that are now inside of my portfolio based off the ETFs and the mutual funds that I pick. The issue that you may have is naturally they're going to be overlapping. You find a lot of times with mutual funds and ETFs that when you look at having a broad base of stocks where they're maybe mirroring an index, it's very hard to not overlap. I mean, that's just the truth of the matter. But because you have the nice diversification and then you have that balance, for many people, it gives them a nice, smooth, expected income that they can achieve from their dividends. Everything's automatically reinvested in their early goings, and they don't have to really keep track of these companies. Where instead of you choosing a few growth dividend investments here, a few aristocrats and kings over there, some high yields over here, instead you just choose the mutual fund and the ETF and you allow the professionals to build the portfolio and then they focus on the investments. There are some very low cost dividend ETFs and mutual funds out there where they have a very passive approach. They kind of find the dividends, they get the companies, and then they just kind of hold on to them. Now, if a low cost passive investment ETF doesn't work for you, there are always actively managed ETFs and mutual funds available where you can find these income producing assets where they invest in bonds, they invest in stocks and the companies, but they just focus on the income. You can take that approach as well, which may work for you. Let me just take a moment and say thank you for watching my video. You know, I always appreciate you guys' time and I do not take it for granted. If you find value in this video, I simply ask for you to like and subscribe so you can continue receiving valuable insight on how to solve generational wealth through strategic retirement planning. Number 5 on our dividend investing strategy is focusing on sectors and industries that pay a high dividend. Now, this works for a lot of people because it's kind of the happy middle between choosing individual stocks and just going straight for ETFs and mutual funds. By choosing the sectors that pay a higher dividend, you open yourself up to being able to be diversified amongst different sectors, which is kind of nice because you'll see that there are some sectors that perform really well one year and then the next year they're on the bottom. And then the sector that was on the bottom last year is at the top this year. So when you diversify amongst these individual sectors, you can put a portfolio together that may perform very well in a variety of different economic climates. Some high paying dividend sectors would include the utility sector, it would include the consumer staples sector, and it would include the healthcare sector. So when it comes to consumer staples, that's normally the stuff that we always need. So those normally perform well in recessions. We always need toilet paper, we always need groceries. There's just some things that we need no matter what's going on. Because these companies are generally very large, like Procter and Gamble, very successful companies, they're often saying we don't really need to reinvest our profits. We already have a large sector of the overall market, and we don't really think the money is going to give us the ability to gain too many more percentage points of the overall market. It's maybe fragmented in some ways. And so what they'll say is, I'll give the money back to the shareholders because they're the owners of the company. And that's what a dividend is. It's a company sharing its profits with you. They believe that it's better to give the profits to you than it is to reinvest it for future growth. That's normally okay when you're talking about very large and successful consumer staple companies. Now, when you're talking about utilities, that one's a little bit different. So normally utilities, they don't actually grow that well as an overall sector. And because you don't have the capital appreciation of the stock and getting the income through capital gains, they often pay a dividend to entice people to invest in them. Now, again, they're also very stable companies, right? Utilities, you always need them. They're not going many places, but keep in mind that those will not grow as well as far as the capital appreciation side of the stocks. And when it comes to healthcare, you'll find that healthcare actually has a pretty nice, attractive return for many of them. The hard part about healthcare is I don't know which company is going to make it. There's so many amazing ideas, so many drugs that are being tested, and it's very hard to pick the right one. So when you invest in some of these healthcare companies, you may find that you're going to get 10, 20, 30% returns, but you may find that you may lose 10, 15, 20% as well. The healthcare sector is a little bit harder to navigate, but if you get stocks in the overall sector, so basically what you would do is you would choose a healthcare ETF, and then you would choose a consumer staple ETF, and then you would choose a utilities ETF. So you'll split that up in your own portfolio in a way that works for you. And then these are normally going to be very high paying dividend companies, but you'll generally have access to some capital appreciation in the healthcare sector. And you'll also be able to have some stable blue chip companies that are probably going to be around forever when you're investing in the utilities and when you're also investing in the consumer staples. The sixth dividend investing strategy, which we've already talked a little bit about, is comparing the dividend yield versus the dividend payout ratio. There are people who will basically say, I'm going to look for high dividend yield, but I'm also going to look for a low dividend payout ratio. When I have those together, I know that I have a safer, more stable dividend because I know that they're not giving out too much of their earnings per share. For many people who like to get into the numbers, who like to investigate, research the companies, this approach works really well. you're able to use a stock screener, which is a very fancy way of saying, like, I can filter through the stock market. I can tell a filter exactly what I'm looking for in a stock. If I say I want a minimum of a 5, 10% yield, but at the same time, I also say my filter, I want to make sure that my payout ratio is lower than 75%, then it's going to give you a certain number of stocks that you can then invest in. And you can build a pretty nice portfolio just using that information alone. And for those of you that do not know, your dividend yield is basically taking your dividend per share and you divide that by the stock price. The higher the dividend yield, it means the less amount of stocks you have to buy because I'm getting a very high return on every time I put the money in. So if I put $100 in and every time I put $100 in, I get $10 back in a dividend, that is a 10% dividend yield. And as a result, you have to buy less stocks than if you had a 5% dividend yield, where every time you bought $100 of stocks, you only got $5 back in the dividend. And that's why a lot of people look at the dividend yield. But the important thing is to keep in mind, what is that overall payout ratio? And all the payout ratio is it's saying how much of my earnings per share is my dividend taking up. If my dividend is taking up 25% of my earnings per share, 50% of my earnings per share, 150% of my earnings per share. And you may say, Dre, why would anyone ever pay more than their earnings per share? Isn't the dividend sharing in the profits? You'll be right. But it is true that a company is allowed to use debt to pay out the dividend. And some companies do because it's so important for them to be able to get the dividend out because they're cash strapped and they know that they could get some people to invest purely because they paid out their dividend. And so some companies are hoping that you don't actually take a look at the financials to see that the dividends were paid out in profits. And as a result, they're like, all right, you don't care if it's paid out in profits or debt. You don't care that the dividend payout ratio is higher than 100% of my earnings per share. You only care that the yield is 25% because that means you don't have to buy as many stocks and you get more money back for your retirement. It's very important that you don't allow yourself to be captured in this dividend trap. And the seventh and final dividend investing strategy we're going to talk about today is international dividend investing. This one is a pretty tough one. So anytime you talk about investing internationally, that's normally going to be reserved for people with a higher risk appetite. And that's because there's so many factors that goes into investing internationally. We're talking about currency exchange, we're talking about the governments and the laws and the courts, and there's so much going on that what a lot of people do is they will look with American eyes out into the world. And they'll say, okay, I can go to the court and I can get a certain result. And that's not true in every country. You may say that there's a constitution and the right to freedom of the press and all this other stuff. And that's not true in all of these countries. We haven't even talked about taxes and coups and economic instability. There's just so much going on internationally that for most people, if you are doing international investing, it's normally going to be less than 10% of your overall dividend investing portfolio. Now, for most people, they're just going to choose an international dividend ETF and they're just going to allow them to choose the investment. And that's often because the average person doesn't have access to international information, right? Again, as I said, there you don't want to look at the rest of the world through the US eyes where we have these laws where you're supposed to be given certain information on the company and its revenue. You're supposed to be able to read through its financials and all this other stuff. There's a ton of international companies that do not have the same financials. They don't have the same accounting standards, and they're able to fudge the numbers even worse than some of our own sectors in the US do. And it takes a very skilled eye to be able to figure out international investing. But you already know, just generally looking at the news today, right? You have the war over in Ukraine, you have the war with Israel and Hamas, where if you are investing in these sectors where you're like, all right, everything seems to be okay, so I'm going to invest over here, I'm going to invest over here, and then poof, things change overnight. And that is the difficulty of international investing. But because there's a higher risk internationally, there's also a higher opportunity of reward. And that's why people do invest in emerging markets and international markets, because there is a higher opportunity for rewards where you may find that the average stock return in the US market may be like 7, 8, 9, 10%. And you may find that the average return in an emerging market may be 15, 20, 25%. But of course, the volatility means you could also lose 50%. And so that is why normally if you have a long-term perspective where you can kind of ride the wave and you believe in the overall stability of the country, then it can work for you. But for most people, because you don't have the time to really keep track of that information, it makes sense to just get an international dividend ETF and just call it a day. Now, what I hope you notice from these 7 dividend investing strategies is you have to do your homework. You got to do the research, and you also want to have in mind that you're taking a long-term approach. Dividend investing is not something that happens overnight. It is something that takes a long time. And for most people, it makes sense to have the drip strategy, which is I have a dividend reinvestment plan where every time I get paid my dividends, I reinvest it so that I can accumulate my wealth a little bit faster. You also want to think about your taxes. There are some places where having a qualified dividend, you could be taxed at a lower rate than just your ordinary income. And last, you always need to keep your risk tolerance and your time horizon in line. If you have at least 5 years, I would say, then you can probably invest in the stock market. If you need your money sooner than 5 years, I would generally discourage you from investing in the stock market. The stock market is just too unpredictable, where you need the time to allow yourself to rebuild your portfolio. If something was to happen where the market had a significant decline, if you have less than 5 years, then you're really just hoping that everything goes perfectly. Because if it doesn't, then you don't have the time to allow your stocks to regrow, which is why I rarely tell people to invest in the stock market if their time horizon is less than 5 years. So I often tell people you got to diversify your dividends. Don't be all in one sector. Don't be all in growth dividends. Allow yourself the opportunity to protect yourself from the unforeseen future. As you guys know, I'm big on ratios, and statistically speaking, there is at least one recession every 10 years. That's how it's been for a pretty long time, and we've been maintaining that trend. As a result, you don't want to get caught being greedy. As Warren Buffett is famous for saying, he's greedy when people are fearful, and he's fearful when people are greedy. You don't want to allow yourself to be caught greedy when the market is making a shift. I always want to thank you for taking the time to watch the video. I'd love to see in the comments which dividend strategy made the most sense to you, or are you going to use multiple strategies, and if so, which ones? Until next time, stay safe and enjoy life.